Hey, everybody, and welcome to this week's NASDAQ Dorsey Wright podcast. My name is Will Gibson, and I have Steve Raymond joining us this week. And Steve's joining us for a particular reason. We're going to be talking about some of the models on our system and some of the changes that we've seen there. Just a high level, if you're not familiar with these, we have some tactical strategies on our research platform, and ones that we're going to be talking about today in specific are our FSM or fund score method models. These models are ETF and mutual fund based, and put high level, we're assigning a fund score to a set of funds, ETFs and mutual funds within a universe, and then we're selecting the highest scoring funds, whether on a monthly or a seasonal quarterly basis, which we'll unpack a bit more today. So Steve and I are going to try to outline some of the themes that we've seen in these quantitatively fund score-esque type of models. So things that we're seeing trending into leadership and the way the models are latching onto that. We'll start with some equity comments, and then we'll conclude with fixed income and probably dabble a bit in between about other things that we've been hearing questions about and some typical guidance that we see for these heading forward. So Steve, maybe just some general thoughts here about starting with the equity side, some themes, some broad themes that we've seen in the models to start this year from your perspective.
Yeah, Will, thank you for having me on. You know, as you move through the months and the quarters, and quite frankly, the years, there are many model updates, because that's what Dorsey Wright does, is work with models for years and years, among other technical data for decades. And, you do run across time frames where everything's quiet and things kind of meander along and we ride leadership. In other words, we ride the momentum wave. Momentum tends to have long waves of trending, and the fund score models, the fund score method really taps into that aspect. And we use different families and we use different providers of vehicle, so that we can use the best inventories available and then pick that leadership. But then there are other times where the market goes through some pretty aggressive transitions. And in those times, you have some moving around in the scores, moving around the relative strength, and quite frankly, moving around in the market, which causes some disruption in the inventory that is being held or being worked with. And I think that, in 2022, as we crossed from 2021 to 2022, we definitely had more another round of disruption in the flavor of where the scores and where the market trends were moving to. So to answer your question, Will, I think that, we've seen a couple paradigms in equity. One is somewhat of a temporal failure in small cap. So small cap exiting a lot of the models over the last few quarters. Maybe a more than temporary, but we'll just say temporary failure in non-US, which led to more non-US vehicles or globally influenced vehicles to move out of the models. And then, of course, a recent flavor would be on the value growth paradigm, where the growth relative strength, seen through scores, seen through charts, however you want to see it, a very real nuance here, have peeled back south and gave up some of the strength. And so at the same counterpoint time, value did not peel back. Value edged up a little bit, but certainly gave more oomph to the value vehicles. And so what we see across our models, and it wouldn't matter if it's ETF based or conservative active managed mutual fund based or aggressive active managed mutual fund based, we see similar themes bleed into all the models, which is moving more from the right side of the market, meaning the growth side of the market, to the middle and left, meaning to the core and to the value side of the market. That seems to have happened through all these models, and certainly so in the last 6 months, and certainly so in the last month. This paradigm shift means that we're owning more weighting in the value and core camp, and much less weighting in the growth camp, and in some cases significantly less in the growth camp. So That means that the models are more, I think, core centric or value oriented. They're in general relative risk dropped, meaning we're moving into more of the low volatility value composite, if you will, across the models. And then certain sectors have changed. So I think that's a big transition. What we need to realize is when, and not only Dorsey Wright, but let's just say other types of investors, when you ride a long trend of something in leadership, and that trend changes or feigns or pretends to change, that's a big shift, because that means a lot of the holdings that you're holding, you've got to move out of the way because they're lagging, and then move into leadership, which might be the new thing. And that's what we're dealing with this time. So we've had 50% turnover across most models, in some cases, maybe more than that. And that means that, we're riding this transition into the more of a core and value mix of assets, and certainly larger cap, meaning the idea of small caps leading and so forth we're not there yet. We're nowhere near that. And lastly, when possible, many of these equity-related models that have commodity exposure access, the commodities and commodity-based sectors where applicable, have moved in to the top scores. So again, another transition. Whereas commodity-related assets, really, you haven't seen any of those in general asset allocation FSM models in many years. So that might put us back to 2010, 11, and 12, and then they kind of disappeared for a decade. So some of those nuances are coming back, and I think that just like always, as you move through the years and the decades, you have to be ready for new trends if as they unfold, even though you don't expect them to unfold that way. But that's why we do what we do. There is no long-term prognostication. FSM models really read the current data and then go with the current data set. So, and I think that's what we're experiencing on this recent update in February, which really is the beginning seasonal quarter or monthly model in the in the year 2022. So kind of a tone changer, you could say, is this update. But Will, back to you.
Yeah, Steve, that's great perspective, I think, and you definitely hit some of the biggest themes that I saw as well in those equity dominant models. A shift of the T, if you will, towards the blend, towards the value side. That's undeniable. I would say across the strategies, same with the preference to large cap. If you have access to commodities, like you said, within the inventory, that was another very prominent theme as well. And then that preference for your domestic equities over international. All of those, I think, are key takeaways from the equity models as we head into the rest of the year. And Steve, you also alluded to some of the intense changes of direction or rotations out of styles last year. For a decade, as we talked about, we've been entrenched, per se, a pretty strong word to use, but helps get the point across that we've been entrenched in a style of market leadership. Now that seems to be changing right now. We've seen this try to change previous times and inevitably stalled out, but this time, as we said, might be different for a variety of reasons. These models, I would say, perhaps think so, but more specifically, I'll kind of toss it back to you on this, and that these models, we mentioned the seasonal quarter update. And seasonal quarter is going to be February, May, August, and November. So that's not your conventional calendar quarter. So there's models update 4 times a year. And last year, as a general observation, I would say, is that these seasonal models really lagged some of the monthly counterparts. So monthly models would update potentially 12 times a year, and then are up for evaluation 12 times a year at the end of each month. And then the seasonal models, seasonal quarterly models would be up 4 times a year. So the less frequently that you looked at the models last year, we typically saw those struggle, as you saw very quick changes of preference and leadership, whereas those monthly models were able to pick up on that. But that is not the long-term historical trend, Steve. So maybe any thoughts there from your perspective, I think, could be helpful as well.
Yeah, that's a big barrel to open. Let's start this way. A seasonal frequency helps the models tap into the long-term bias of the market, which does have seasonal demarcations in its behavior. It's a great way to tap into market trends without a lot of frequency. And high frequency is usually, especially with mutual funds, high frequency moving around is sometimes not possible, although with ETFs, it certainly is possible. But with the investor or registered investment advisors, point of view, high turnover, is not necessarily attractive. So you can think of seasonal as a very efficient way to capture market trends. Now, the byproduct or the counterpoint could be, well, what if we bite on the wrong micro trend and then we have to hold it for a full quarter versus a full month? Well, that could set you back. That has happened historically, all through different points in history. But on balance, the seasonal quarterly models, tend to outperform other frequencies simply by holding on, to leadership. And then, like we mentioned, we're going to run into some problems once in a while. And I think last year was a good year, and this year is still not out of the question. In fact, the same paradigm affects both years, or could affect both years. It definitely affected 2021. Which is the models see an increase in a trend somewhere, in this case value, and bite on it. And then the value dissipates and goes back to a growth counterpart. So you might call it a head fake, but that's a real trend that appeared and then disappeared, and the models will follow that. Now, another way to think of it is we do have monthly models where applicable. We don't have a lot of monthly models with mutual fund companies that don't allow for fast or really highly discourage fast frequency trading. But a monthly model is there on the website, and the reason they're there is to give the users, and the brokers and ourselves, the choice to understand if the market's in transition. We have a monthly version as well as a seasonal version to use our wits to kind of keep on top of those stories. And so I would say the monthly models are there for a reason, and the seasonal models are there for a reason. And you take strong encouragement that they're there so you can use both, but keep in mind that there are advantages of each in their own right. And so seasonal models, I think, capture long-term trends very well, and will continue to do so. Monthly models are more accurate with inside a frequency, but quite frankly, they can be misled also. So there's pros and cons, but I think having both of them is the real solution. And we have advisors that use seasonal for, let's say, a bulk of money, and then monthly models as satellites around there to make sure that they're, on some more shorter term trends that might occur. So I think they're both valuable. But yeah, once a trend appears or disappears, you've got to step in and grab the wheel and say, hey, maybe we need to make another adjustment. Another story behind seasonal, might go this way: 4 times a year, as the advisor, you move in and you make adjustments according to the model. That could mean, and I've said this for quite some years, is that could leave you with 1 or 2 other spots during the year where you might need to jump in and do something different if you feel it's better, but you don't have to. So those are some leeways of how to take both kinds of models and blend them together. Keep in mind that our long-term experience with seasonal is that they outperform longer term, to a better magnitude. And then, the statement to make for monthly models is that they definitely are, more accurate each month, but are easier to take head fakes. In 2021, I think that the transition markets, really stung, a lot of people in some cases, in some models. In 2022, we hope not. But I think that's, as the advisor, you realize you're working with, I think, a great system. and then you play it, you play it month by month. Now, keep in mind also that seasonal models do check for market offense and defense monthly. They just don't recapitulate the inventory monthly, but they do check offense and defense. So again, there is a frequency of both seasonal and monthly, which go hand in hand together. And hopefully that's a good arsenal for the investment advisors to use. Certainly in 2022. Will, back to you.
Yeah, I think that's a great way to think about it. I know I personally was talking to people last year, and some of these models that we're talking about, the intra-period, they would call it business risk of having to wait to the next quarter or wait to the next quarter to make some of these changes. And like you and I have observed, and specifically yourself, you have seen that performance favor that seasonal model that keeps you in some of those trends a bit longer and is less sensitive, if you will, to those month over month changes. So I think there's something there for both people that need to manage some of that interim business risk, but also keep in mind that we're investors here. We are looking for longer term trends to latch onto, and hopefully 2022 we can get more of a trend to latch onto. I think 2021, something else we should mention is that these score-based models are trend following in nature. So when there's a very choppy trend or lack of one for that matter, at least on the sectors and size and style front, it's going to be tough for these to go out and find outperformance. So hopefully 2022, with the recent adjustments these models have made, we can latch on to this trend and see this continue as we head out for the rest of the year. That'd be a great story for momentum models or any trend following strategy for that reason. So maybe Steve, just last few thoughts here before we hop on to maybe some of the fixed income themes that we saw on the equity side. Were there any models that you wanted to hit on in particular, or changes that we wanted to talk about, performance, recap, anything of that sort?
Well, I might make a couple points. The American funds model, which is highly followed, did move into a quasi value and equity income type of mix with a little bit of growth with AMCAP. I just think it's a very interesting mix. It's very low vol when you net it out over 5 positions. Keep in mind that if the market heats up and we need to increase volatility, keep in mind that current configuration is a little bit low vol. So keep that in mind, as we move out here to May. The core U.S. core solution, no change. How you like that? No change, sticking on track with, an equal weight and a growth perspective, and doing rather well in that. And then a first trust self-direct equity model, which has a lot of high R risk options in it. And it mapped to the market, to the current flavors that we're seeing as we cross to 2022. So a lot of energy and natural gas and banking and commodities, rising dividend, almost like a who's who of what we're actually seeing as we crossed into 2022. So, some models are able to hit a more accurate sector stratification. Others are not able to, on purpose, not able to keep it more diversified. But I think there's a lot of stories to tell within the equity camps. Keep in mind that I think that one of the, I'd like to state that the core of the market's doing very well. What is the core of the market? Well, it's kind of an equal-weighted smidgen of large cap pillars of companies in the globe that happen to be, U.S. dominant, with a blend of value, core, and growth, kind of as a fishbowl. Now that index, if you will, or that concept, if you will, is doing very well. It's the real action of play, the real paradigm that we would want to keep an eye on as we move towards May is this value growth paradigm. That's the one that really is going to make a difference between your experience, the advisor's experience, the model's experience. The value growth paradigm is going to have a big impact on what's going on, and let's just say from here to May. So those are the things to keep in mind that we want to continue to check on the models. Quite frankly, there has been a value shift in the models, so you want to keep on top of that trend for any improvement in that trend or any erosion of that trend. The reason I mention it that way is that historically, going back 20 years, let's say go back 30. The super dominant trends have very high readings in some indicators regarding relative strength. I mean, very high. Not talking about score here, talking about underneath, participation, how many funds in a particular group have very strong readings against the market. It is the case in 2022 right now that value is running around, let's say, 32% of the value options have great relative strength, let's say a third. And, much less than 20% of growth options have great relative strength. So you're really talking about a narrow market here. The idea that none of those groups, the two I just mentioned, have 70% or 80% of their members with dominant relative strength. So I think that we're in a market where you have a value bias, but it's not over dominant. So, like you mentioned, we have to keep an eye on these trends as they transition. We're not out of the woods yet on either side. We have a value preeminence, but not dominance. And we have growth peeling back, and we'll see, if it could reignite. But right now, I think you've got a horse race here. And although horse races are fun to watch, no one likes to be in one. So 2022 is a little bit of, keeping your eye on the ball, staying nervous. I think nervous is good, staying on top of the data as we see this thing through. But that kind of gives you, kind of a game plan of saying you've got the models, you've got the frequency, some of the top line commentary, and then really we want to make it to May, and then see where we stand. Will, back to you.
Yeah, that's great, Steve. It's going to be an interesting year, certainly for the models, for the market as a whole, especially with the talk around interest rates lately. Perhaps a lot of that trickling over into some of those equity model decisions. Just a few parting comments here, maybe about some of the fixed income models, and then we'll wrap up here. Given that I think a bulk of our conversation revolved around the equities for spillover from fixed income per se, but on the fixed income side, I would say the only real trend that we saw from the fund score models would be that preference for floating rates. We saw that move into a number of the fixed income strategies or anything not long duration sensitive or long duration-esque from what we saw. So, Steve, just your last thoughts on any fixed income changes that we saw, any particular models that you wanted to mention is a fair game.
Well, I mean, the models are behaving in context with the bigger market fabric. And, Franklin, for example, is a renowned classic fixed income shop. And just like you said, Will, the floating rate is number one, and the model has the most likely success rate based on what we think we see. And the right thing to do based on what we know about the interest rate environment rising. So, and PIMCO has similar things, but in both those models, or let's say in any model that you run, keep in mind that some of these choices in the fixed income models are actually also dip into what I might call equity income and high yield, which are phantom, equity groups in a fixed income model, if you will. So like the Franklin Income Fund is a hybrid. It also ranks at number 2s in the model and can do very well in heavy dividend, high yield, doing well in those types of markets. And so I think that's, PIMCO has an all asset rotation or all asset authority. fund, which again, similar concept where income is really what we're going after, whether it's from classic or purebred fixed income tranches or not is a secondary comment. So, and that might be what the advisor has to contend with as we go forward, that you have to, come up with what are the best options in my income universe. Floating rates would be one. There are other choices that could come to light, like convertible or high yield, but certainly anything working with dividends or gaining income is what we're seeing, and quite frankly, what we may continue to see, going forward. Now, one other idea would be is that I recall many market transitions over the years, and what I've noticed is that providers like mutual fund companies, or in this case, or in other cases, ETF providers, that the smart people up there, they find a way to invent products that work in new paradigms. So when one says, well, interest rates will probably go up for the foreseeable future, that could be true. But I wouldn't equate that with there'll be no product that can work in that environment. I think the products will come. Right now, as we're dealing with this current transition in the bond market after 30 or some 40 years, I think that, like Will, the floating rate, the equity income, the hybrid income, high yield income, convertible, those kinds of mixes can, where applicable, where the score shows, those can provide a way out of this. And then we keep going on down the road, so that's how this works. When a major group, a macro asset class faces challenges, we go with what we have, we go with what we know. And then, as I mentioned, as a secondary point is that providers may indeed invent product that work in situations or eras that you didn't even realize those products will be invented. So I'm throwing that out there as as something to consider. The Franklin model is doing well this year. It's positive for the year. So these are things you do. You have to work with what you have. And I think that, kind of gives a flavor of the update. And again, I don't want to discount emerging market incomes or bonds or these things. But quite frankly, we haven't really seen relative strength there in order to make any comment about we hope for that, but anything's possible, including that interest rates actually don't rise. Keep in mind that it reminds me of an old story that I actually lived through. In early 2000s, inverse bond funds first became built, meaning they first offered. Again, coming back to this story I just said, where people invent product that might match new paradigms. Well, that was 20 some years ago, or let's say 21 years ago. And upon invention, it also coincided with the idea back then, because the idea back then was interest rates will definitely rise forever from then. And that was a 20-year mistake. If people bought into that, which they did. So the idea would be is that there are new paradigms. Some smart people forecasted that interest rates should start to rise in the early 2000s. They did not. Next, they picked on 2012 and beyond, and were not gratified there. I remember a big push, even by some major market technicians and people in the know, at 2015 would be the rising rate market beginning. It didn't happen. So here we are, this one. I just want to point this out. So yeah, we're confident that rates are rising, and we're hearing the stories that everyone else hears. But also keep in mind that the story's not the end of the story's not here yet. So you got to play what we see when we see it, and if things change, we change. So take that as encouragement. as you're working with your own relative strength research, or certainly with our models. Will, back to you.
That's great, Steve. Yeah, and kind of dovetailing off that point, I guess, beware of the crowd. Just be aware of, maybe know the other side of the trade better than the side that you're on. Sometimes can be a very helpful thing, at
Good
least.
point.
Yeah. So anyways, I think that's what we really wanted to hit on today. Hopefully that gives everyone a flavor of some of the fund score models. So those quantitatively trend following ETF and mutual fund models that we have on our research platform, gives you an idea of how those are positioned after that first main seasonal quarter of the new year. Looking forward to see how that develops later on. So Steve, maybe hopefully you can come on and chat about these later in the year and see if what they're biting on right now is going to stick and to be a theme for the rest of the year. So for those that don't know what these fund score models are, but you made it through the podcast to this point, if you're listening on YouTube, we do have our research platform linked in the comments. You can find more about them there, or you can always reach out to us by phone or email. Phone is 804-320-8511, or our email, dwa@dorseywright.com. I want to remind you that's not a black box. We will reply to you personally through that email. So any questions about what we talked about, we're accessible via those mediums. And I'll go ahead and conclude here. So Steve, thanks again. Thank you all for listening, and we'll look forward to talking to you next week.